Here's a summary of the UPS Q3 2025 earnings call, designed for easy listening. Introduction. Good morning, and welcome to the UPS third quarter 2025 earnings call. Today, we're joined by our CEO, Carol Tomé, and our CFO, Brian Dykes, along with other members of our executive leadership team. We'll be discussing our adjusted financial results today, and any forward-looking statements are subject to risks and uncertainties as outlined in our SEC filings. CEO's opening remarks. Carol Tomé. I want to start by thanking all UPS employees for their incredible dedication. The third quarter presented us with numerous tariff changes, both anticipated and unexpected, and our team navigated these with remarkable skill. We also made significant progress on our network reconfiguration, a crucial step for the future of our U.S. operations. Financially, our consolidated revenue for the third quarter reached $21.4 billion, with an operating profit of $2.1 billion and an operating margin of 10%. Our cash flow pressures from the second quarter eased, bringing our year-to-date free cash flow to $2.7 billion. We maintained our focus on revenue quality. While U.S. average daily volume declined due to a planned reduction in Amazon volume and less profitable e-commerce business, we achieved a strong 9.8% growth in U.S. revenue per piece. This, combined with excellent expense control, led to a 10 basis point improvement in our U.S. operating margin, despite a significant drop in average daily volume. Internationally, we saw 4.8% growth in total average daily volume, with exports up 5.9%. Our international operating margin was impacted by shifts in trade policy, moving volume to lower margin lanes. However, our healthcare segment delivered robust revenue growth. Operationally, we are enhancing our global trade capabilities, especially our customs brokerage, leveraging AI to process over 90% of cross-border transactions efficiently. Following the removal of the de minimis exemption for U.S. imports, we saw a tenfold increase in customs entries, which our upgraded systems handled effectively. We're also excited about our acquisition of Andlauer Healthcare Group, expected to close in early November, which will bolster our global healthcare logistics. Our digital access program continues to perform well, serving over 8 million SMBs and generating over $2.8 billion in revenue year-to-date, with a full-year projection exceeding $3.5 billion. The Amazon volume glide down is on track, with Amazon's total volume declining by 21.2% this quarter. We closed 93 buildings as part of our network reconfiguration. We also completed a successful voluntary retirement program for our long-serving drivers. Regarding peak season, while we anticipate strong volumes from our top 100 customers, the overall U.S. peak average daily volume is expected to decrease due to the Amazon glide down. Our Network of the Future initiative, along with automation, with 66% of volume expected to move through automated processes in Q4, positions us for our most efficient peak season ever. For the fourth quarter, we anticipate consolidated revenue of approximately $24 billion and an operating margin of roughly 11% to 11.5%. UPS is undergoing its most significant strategic transformation, focusing on high-value markets and complex logistics. We are well-positioned with ample liquidity to support this transformation and deliver long-term value to our stakeholders. CFO's remarks. Brian Dykes. Good morning, everyone. I'll now provide more detail on our Q3 financial performance and our outlook. Third quarter results. Consolidated revenue was $21.4 billion, operating profit $2.1 billion, and operating margin 10%. Diluted earnings per share were $1.74. A significant contributor to EPS was a $330 million pre-tax gain from a sale-leaseback transaction involving 5 properties, which we've included in our non-GAAP results to free up capital for reinvestment. Segment performance, U.S. domestic. Revenue was $14.2 billion, down just 2.6% year-over-year despite a 12.3% decline in average daily volume. This strong revenue performance was driven by a 9.8% increase in revenue per piece, the highest in 3 years. Expense management was also excellent, with total expenses down 2.7%. U.S. domestic operating margin was 6.4%. International. Revenue was $4.7 billion, up 5.9%. Average daily volume grew 4.8%, led by Europe and the Americas. Operating profit was $691 million, with an operating margin of 14.8%. This margin was pressured by trade lane shifts and lower demand surcharges. Supply chain solutions. Revenue was $2.5 billion, lower year-over-year primarily due to the divestiture of Coyote. Revenue in air and ocean forwarding declined due to lower market rates. Healthcare logistics revenue grew, and UPS digital revenue increased 9.5%. Operating profit was $536 million, including the gain from the sale-leaseback. Cash and shareowner returns. Year-to-date, we generated $5.1 billion in cash from operations and $2.7 billion in free cash flow. We have strong liquidity and have paid $4 billion in dividends year-to-date. Cost out and network reconfiguration. We are executing our largest network reconfiguration ever, aiming to remove approximately $3.5 billion in costs this year in conjunction with the Amazon volume reduction. Total operational hours are down over 16 million year-to-date. Operational positions are down nearly 34,000 year-over-year, including reductions from our voluntary separation program. We have completed the closure of 195 operations, including 93 buildings. We have deployed automation in 35 facilities, with an additional 66% of volume expected to go through automated processes in Q4. To date, we have reduced expenses by $2.2 billion, on track for our $3.5 billion target for the year. Fourth quarter outlook. Consolidated. Revenue of approximately $24 billion, operating margin of 11% to 11.5%. U.S. domestic. Revenue around $16.2 billion, operating margin of 9.5% to 10%. We expect earlier peak volume and efficient operations due to network enhancements. International. Revenue of approximately $5 billion, operating margin of 17% to 18%. Supply chain solutions. Revenue of around $2.7 billion, operating margin of approximately 9%. Capital allocation. Full year 2025 capital expenditures are expected to be around $3.5 billion. Dividends are projected to be around $5.5 billion, subject to board approval. We have completed targeted share repurchases of about $1 billion. Our full-year tax rate is expected to be approximately 23.75%. UPS is in a strong financial position with ample liquidity. Following the anticipated completion of the Andlauer acquisition in November, we expect to end the year with around $5 billion in cash. Key financial metrics and highlights. Consolidated revenue. Q3 2025 $21.4 billion consolidated operating profit. Q3 2025 $2.1 billion consolidated operating margin. Q3 2025 10% year-to-date free cash flow. Q3 2025 $2.7 billion U.S. revenue per piece growth. Q3 2025 plus 9.8% U.S. operating margin improvement. Q3 2025 plus 10 basis points international average daily volume growth. Q3 2025 plus 4.8% Amazon volume decline. Q3 2025 minus 21.2% buildings closed. Year-to-date 93 cost reduction. Target. 2025 $3.5 billion, on track. Q4 2025 revenue guidance, $24 billion. Q4 2025 operating margin guidance, 11% to 11.5%. Key lowlights, U.S. average daily volume decline, primarily due to planned reduction of Amazon volume and lower yielding e-commerce. International operating margin pressure, resulting from trade policy shifts impacting trade lanes. Supply Chain Solutions revenue decline, due to divestitures and softer market rates in forwarding. Ground Saver average daily volume decline, significant decrease due to actions related to Amazon and lower yielding e-commerce. Density challenges in Ground Saver, difficulty in achieving higher packages per stop on residential deliveries. Management's forecasts for future quarters/years, Q4 2025. Consolidated revenue of $24 billion, operating margin of 11% to 11.5%. U.S. domestic revenue $16.2 billion, margin 9.5% to 10%. International revenue $5 billion, margin 17% to 18%. Supply Chain Solutions revenue $2.7 billion, margin 9%. 2025 full year capital expenditures $3.5 billion, dividends $5.5 billion, share repurchases $1 billion, tax rate 23.75%. 2026 outlook. While specific guidance wasn't provided, management indicated that the Amazon glide down will continue into the first half of 2026, with ongoing cost takeout. Strategic actions around Ground Saver are expected to yield economic benefits in the back half of 2026. They anticipate continued revenue per piece growth and higher margins as the Amazon glide down completes. Significant risk factors, trade policy shifts, ongoing changes and uncertainties in global trade policies, including tariffs and trade lane dynamics, continue to impact international business. Amazon volume glide down. While on track, the continued reduction in Amazon volume requires ongoing network reconfiguration and cost management. Evolving e-commerce landscape. The shift away from lower-yielding e-commerce volume requires strategic adjustments. Global economic conditions. Broader economic slowdowns or recessions could impact shipping demand. Regulatory changes. Potential impacts from upcoming Supreme Court hearings on tariffs and to minimize regulations. Operational execution. Ensuring smooth operations during peak season and managing network changes effectively. Most important statements from CEO and CFO, CEO Carol Tomé. Amid a rapidly changing global environment, UPS is undergoing the most significant strategic transformation in our company's history. We are focused on excelling in critical areas, capturing high-value market segments, and accommodating customers with increasingly complex logistics requirements. CEO Carol Tomé. Our network reconfiguration and cost-saving initiatives are on course, and we expect profit improvements from our Amazon glide-down efforts. CFO Brian Dykes. UPS is rock-solid strong, and we have plenty of liquidity to continue executing our strategy and return value to our shareowners. CFO Brian Dykes. We've reduced expense by $2.2 billion so far this year and are on track to achieve our 2025 expense reduction target of approximately $3.5 billion. This concludes the summary of the UPS Q3 2025 earnings call.